Welcome to Fear and Greed Summer Investing Series, brought to you by Vanta, specialists in compliance-led growth. I'm Sean Aylmer. 2024 was a challenging year for the supermarket giants, headlined by the consumer watchdog's allegations of sham specials and price gouging. So what next in the battle between Coles and Woolworths, and what's it mean for investors? As always, this is general information only, and you should seek independent advice before making investment decisions. Ben Gilbert is the head of Australian research at Jarden. Ben, welcome back to Fear and Greed.
Thanks, Sean. Thanks for having me.
Bit of a shocker 2024 for the supermarkets, Ben.
Yes, well, I think just about everything that could go wrong has gone wrong. We've had multiple inquiries. We've had Senate inquiries. We've had some strikes more recently. You've even had New Zealand now launching a case against Woolworths on the pricing side. So it hasn't been a great time to be in supermarkets.
How big a risk is this for the supermarkets going forward as an investment option?
Yeah, look, I think what we're going to find is that the noise and the rhetoric is going to settle down over the next year with respect to supermarkets, and hopefully consumer trust in the two big majors can't get any lower. And so ultimately, I think it's going to be up to Coles and Woolworths over this next year to really get in the best position to engage with shoppers and get them back into store and build confidence. The other thing I'd envisage as well is as we move into a more normal macro backdrop, if there is such a thing, as we start to see inflation stabilise through this year and we get a bit more confidence that our grocery prices aren't going to be jumping around all over the place, consumers will start thinking more broadly around what they want when they go into the supermarket. Things like service, things like range, all these sorts of things that we valued a lot more probably pre-COVID will probably come more back front to mind, which in theory should benefit Coles and Woolies being the two big full-service supermarkets in Australia.
Those two, they haven't had a good 12 months in terms of share price appreciation or depreciation, as the case may be. What about the next 12 months? Do you think the fact that interest rates falling, maybe the cost of living crisis comes off a bit, the things you're talking about could benefit the supermarkets in share price terms?
Well, I think so. And generally speaking, we're optimistic. The grocery market this year should be growing mid-single digits. In that backdrop, the supermarket should be able to deliver mid to high single-digit earnings growth. You throw in there a bunch of other things that they're doing around building out their digital media capabilities. They're driving loyalty and adjacencies and all these other fun things. There's a pretty material profit opportunity. And I think the best case in point is Walmart. When we look at them offshore at the moment, what we saw through last year is that they'd put out some results where they started to see material contributions from some of these other revenue streams, being sort of digital subscription, these sorts of things. The stock re-rated over 20%, and what it allows them to do is put more money back into price to ultimately benefit the consumer. So it's a big opportunity. Now, the caveat to all of this is competition, and what we're continuing to see out there is whether it's Bunnings pushing more into pet or cleaning, whether it's Amazon growing significantly in grocery, whether it's Chem Warehouse, whether it's Reject Shop. There's definitely a much more blurred lines, if we can sort of put it that way, between what we sort of see as a traditional supermarket and we're prepared to buy groceries each week.
Final question, where does it sit in a portfolio? Are they still defensive investments, the big supermarkets?
It's an interesting question, and it's something we've been pondering a lot. And through the back end of last year, we actually put out a big report having a look at category killers versus defensives. And what I think we're finding now is looking forward is that the whole defensive should trade at premium multiples of the safest place is starting to be thrown out the window a little bit. And really, I think what we're looking for is companies that consistently can grow share, consistently can expand margin, and consistently surprise positive around earnings expectations. And the supermarkets obviously haven't done that over the last 12 months. Now, if they can move back into that place over the next 12, then look, they'll be defensive, they'll be category killers, and hopefully the share prices can outperform. And time will tell, I suppose.
Ben, thanks for talking to Fear and Greed Summer Investing Series.
Thank you very much.
That was Ben Gilbert, Head of Australian Research at Jarden. Remember to get your own independent advice before making any investment decisions. This is Fear and Greed's Summer Investing Series, brought to you by Vanta. Vanta automates compliance for frameworks like ISO 27001, SOC 2, CPS 234 and Essential 8, saving time and money while building trust. Join over 8,000 companies like Atlassian, Dovetail and FireAnt, managing real-time risk. Get $1,000 off at vanta.com/fearandgreed. I'm Sean Aylmer. Enjoy your day.